Welcome. Today we will be talking about inflation, an economical concept most of us have heard of before but not many understands fully well. The base concept is really simple. It basically is a percentage that shows the overall buying power, the change in the value of a nation's currency. Most of us who are older than 10 to 15-year-old have come across this change, and I'm pretty sure you all have memories about it. Just think of how buying bread or a scoop of ice cream or something back when you were a kid cost far less than it does today. This is mostly because of inflation. This picture illustrates this quite well. It shows that a $100 bill in 1913 would only be worth about $3.87 today. In other words, what you can buy today for $100, you could have bought back then for $3.87. This inflation is mainly the cause of a nation's money supply outpacing its economic growth. That sounds good and all, but what does that really mean? Well, you can think of money as, let's say, a collectible, some kind of an item. What determines the value of that item is multifaceted. There are many different things that can determine that. One of which is, let's say, the basic supply and demand. Like if something is really popular, many people want it, but you can't produce that many of it, then the price will increase. Its value will increase. This is the demand pool inflation. This sort of inflation happens when the market can't keep up with the public's demand, so the prices of products and services rise. The same effect can be reached by simply introducing more money into the system. If you go back to the item metaphor, if there are more of a collectible, it tends to worth less. It's the same with money as well. However, there's a caveat. In money's case, it's actually a fairly difficult issue, because if you print more money and introduce it into an economy, of a well-working economy, then it tends to decrease interest rates, which encourages businesses to begin bigger investments, grow, take on more people, thus decreasing the unemployment rate, which can help out the normal everyday guy. It also, because more money was introduced into the system, which also helps out the normal everyday guy, their spending habits will also most likely change. They will tend towards spending more money. And the more everyday people spend, the better businesses do. And since business is growing because of the small interest rates, that can also feed into the economy, overall encouraging a positive to stagnating inflation rates. The second way your collectibles can increase in value is if the materials that make it up or the labor that produces it becomes more pricey. This is the so-called cost push inflation. This is a bit less self-explanatory, but basically it represents that your everyday items that you buy become more expensive to produce as time goes on. With time passing, the materials that make them up become rarer, and since usually we tend towards better economic systems everywhere, and the wages of people that produce those items also tends to go up. Both of these are cost into the items you buy, so their price will increase as time goes on. If you wish to track inflation and you live in the US, you can do so by googling either Consumer Price Index, CPI, or Wholesale Price Index. If you live everywhere else, it might take some surge, but your country should have something very similar. CPI basically tracks the average prices of certain products and services and depicts the changes in set prices. If you check it out, it basically shows how things get more and more expensive as time passes. VPI is similar, but it tracks items sold in bulk, traded by companies It's not on the retail level, but still it really transits down to the normal people's buying habits as well. Whether inflation is a good or a bad thing for you, well, that really depends on what kind of a person you are. For anyone who has long term investments towards buildings and companies, or holders of stocked commodities like minerals, oil, and other such objects, tend not to care too much about it because it's either priced in or it will even increase the price of their holdings. So, long term, it's either a negligible effect for these investors or it might even benefit them. However, it is a huge, huge problem for those who hold their money, their wealth in cash. For those who mainly use cash, live in the world of cash, especially if their savings are in cash, for them it's just a clear loss. It's really, really crucial for this very reason that you always, when you're thinking about your future, you should always make sure that you don't lose out as much as possible. And in this case, that means that some, if not most, of your savings should be in some form of investment where inflation is already cashed in or it will appreciate to negate its effect. The opposite of inflation is called deflation. It's basically pretty self explanatory. It's when the value of money increases over time. This might sound nice in the short term because you have $100 and now it's worth 120. So basically you got free money. But if you really think about it, it kind of collapses the economy system altogether on the long term. Think of it this way, right now it's worth it for you to put your money into the bank or invest it into something. That helps the economy because your money is actually circulating, it's in the market, it's being used actively to help whatever area you invested into. In deflation's case, you would be pretty highly encouraged to keep your money in cash. And the more you keep your money in cash, the less you spend it, the less you use it to fuel the economy, which basically just takes money out of circulation in a sense. You would be encouraged basically to hoard money, hoard cash under your pillow, which is quite obviously just horrible because the companies would use that money to invest, to build, to grow, and without that, their services would suffer. And because of their services, you would suffer as well. All in all, while high level of inflation is obviously quite negative, in general, a small or a constant rate of inflation is a sign of a healthy economy. In the US's case, for example, it's been manually capped at around 2% by the Federal Reserve, which is a pretty decent move to keep a stable and steady economy. It also helps you to plan that in. While in other countries, inflation fluctuates all over the place, in the US it's fairly well managed. Although this 2% is fairly well managed, as I've said, but the recent virus and the other surrounding economical problems may actually result in a short-term increase, but most likely nothing too concerning in the case of the US, which is a very strong economy. However, in other countries where the toll of recent events have been much more severe, extreme cases of inflation or maybe even deflation in some cases can be there. So keep a watchful eye out this time around. To protect yourself against inflation, you basically just have to embrace investment, any form of it. It can be in treasuries, ETFs, buying property, buying options, although I wouldn't recommend it, we'll get to there later on, but some form of investment. Keeping your money in cash is, in a sense, unless you're gambling it away, it's one of the riskiest things to do with your money. After all, thanks to inflation, you always lose money with it on the long term. And of course, all of the previous examples for investment, they all work on the long term. On the short term, keeping your money in cash may be viable. This is where problem really starts, and this is what we will get into in later videos. For now, the next video will be about debt, how it influences all of our lives, and how we can manage it in a very decent level. Until then, like and subscribe, and thank you for watching, and I'll see you in the next video. Bye.